is looking ahead to the reopening of the Chinese markets on Monday local time, Sunday night our time, and are expressing a worry that there could be a real major sell-off there in the double-digit area. That's just my number, not anything I've seen anywhere, and that would certainly reverberate back to the U.S. So you don't want to go into the weekend long.
Exactly, Tyler, and that's the message that we're seeing and that we've seen all along. While this has all unplayed, the Chinese market, that has been closed, right? So we've been trading our markets and waiting to see how the markets are going to react, both U.S. and internationally. We saw this activity last Friday. The risk-off trade went on, and it went on very fast. We're seeing it again today. No one wants to be long this market going into the weekend, especially with China opening next week. All indications are going to show us that there is going to be significant pressure on those markets, and rightfully so. They haven't had their opportunity. The news cycle continues to be one way. The news is all negative. We haven't had any real positive headlines relating to this just yet, and until we get that, the selling is going to continue. So this has been, this has been pent up for a long time, and we're going to start seeing that market hit Sunday night.
Jim, put this into context for us. I don't mean to minimize it. 556 points is 556 points. It's almost 2% decline in the Dow. But that's not cataclysmic.
Not even close to cataclysmic. It's just, to me, you can say that in a month and a half, we may look back at this and go, well, that's kind of the correction we need. And I actually think that's what's going to happen. I think we take it down to about the 3,100 level in the S&P, which will amount to about a 7 or 8% correction. What we're seeing today and last Friday is the Friday multiplier. You mentioned the Chinese stock market opened up. That's fine. But when you look at the weekend in 2 days where you don't have market access and you ask yourself, what's the likelihood of a negative headline versus a positive one? And it's overwhelmingly disproportionate to negative. I mean, we're still in the early stages of this. The earliest we could start to hear good news would be in a couple weeks when the people who've been contaminated now start to see it. But there's one thing I'd like to point out is that there's the health risk that's obviously grave and huge. But we're talking about the market risk, and that's about fear and perception and consumers' behavior. If they start, like if you were scheduled to go on a cruise ship this week, I know if it was me, and I'm not trying to cause scare, but I would have some trepidation about doing that. I think people feel the same way about going to crowded restaurants and bars, and I think it's at the infant stage of it now, but that could be a big deal, and it could be an economic, a huge economic lockup.
Jim, I realize...
And Tyler... Sorry, just to follow up on Jim's initial point, this market, this pullback that we're seeing now, 2%, is probably going to be insignificant. Go back to December 2018. We were expecting a Santa Claus rally. Markets sold off after rallying the prior months leading into that. And January, too. If you look at the 2019 chart, December and January from 18 into 19 traded down, and then we went straight up. So this just might be our, beginning of the year, flushing things out. We're essentially flat to where we ended the year in 2019.
Yeah, to that point, Jim, I realize the coronavirus angst is playing out in markets the world over right now. But how much of this is also the fact that we've had disappointing earnings, and in some cases not even earnings, but outlooks coming into 2020? You've had softer than expected data, and then, of course, you do have all of this uncertainty in D.C. amid impeachment, Iowa caucus, et cetera.
I think the earnings thing is mixed, because if you look at both Apple and Amazon, they did quite well, and they're kind of the bell cow of earnings season. Tech week is, in my mind, is like 40%. So if I have to give what's the coronavirus part of it, I'd say of the fundamental part of it, 90%. But the other part, remember, when this kind of thing happens at Market Eye, for the month before the end of the year, I talked to scores of people, and they're like, well, what do we do now? I said, you rebalance. When you've had a huge year, you rebalance. Well, nobody rebalances until markets begin to correct. And that's kind of the life of a correction. At first you get the big pullback down, you try to make it higher, and then people are like, wow, I got too much risk on. And that's not just on the personal level, that can be on the hedge fund level too. So I think that's the second stage of a correction comes now. And that's predicated on a bad close today, because I think the market's held up relatively well considering what the story could be.